Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about ZAI LAB Limited annual report. ZAI LAB Limited is a biopharmaceutical company that focuses on discovering, developing, and commercializing products to address various medical conditions. Its portfolio of commercial products includes ZAI LAB for ovarian cancer, VYVGART for myasthenia gravis and chronic inflammatory demyelinating polyneuropathy, NUZYRA for bacterial infections, Optune for glioblastoma multiforme, Kinlock for gastrointestinal stromal tumors, Zacjuro for hospital-acquired pneumonia, and Ogtiro for non-small cell lung cancer. In addition to its commercial products, ZAI LAB Limited has a robust pipeline of licensed and collaborative agreements with various companies. These partnerships include collaborations with Tesaro, Inc., NovoCure Limited, Deciphera Pharmaceuticals, LLC, Paratech Bermuda Limited, Argenx BV, Turning Point Therapeutics, Inc., Entasis Therapeutics Holdings, Inc., Karuna Therapeutics, Inc., and Pfizer, Inc. To develop and commercialize products such as niraparib, tumor-treating fields, ripretinib, amidacicline, efgartigimod, repotrectinib, durlobactam with sulbactam, xanomeline and trospium chloride, and tisotumab vedotin. Overall, ZAI LAB Limited's business model is centered around the development and commercialization of innovative products to address various medical conditions. Its partnerships with other companies demonstrate its commitment to collaboration and innovation in the biopharmaceutical industry. ZAI LAB Limited maintains a market capitalization of $18 billion, broadly in line with the industry peer group. ZAI LAB Limited trades at a lower price-to-book ratio of 0.31 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 39% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through an analysis of the key factors that have impacted sales for various products within a company. Revenue growth is primarily driven by increased demand and adoption of certain products. For instance, strong patient demand and expanding hospital adoption have led to higher sales for XACDURO and NUZYRA. Additionally, collaboration revenue has seen significant growth, with a 117.1% increase in 2025 compared to the previous year. This is largely due to partnerships with companies such as Argenx, Novo Holdings, Paratech, NovoCure, and Deciphera. On the other hand, revenue decline can be attributed to specific challenges faced by certain products. For example, VYVGART and VYVGART Hytrulo have experienced a decrease in revenue due to rebates related to NRDL renewal and price adjustment. Similarly, ZEJULA has seen a 1% decrease in product revenue. Overall, the drivers of revenue growth or decline are largely influenced by market demand, adoption rates, and partnerships with other companies. The company's financial performance indicates that it has been generating positive operating cash flow in some years, but the consistency is lacking. On page 40, the operating cash flow for 2025 is reported to be $143,509, which suggests a positive trend. Furthermore, on page 55, it is noted that there was a significant shift towards positive operating cash flow from 2024 to 2025, with an increase of plus $64,080 in net cash used in operating activities. However, the data also shows that the company's operating cash flow is not consistently high across all years. On page 62, it is simply stated that the operating cash flow is positive, without providing a specific amount. Additionally, on page 64, the operating cash flow is reported to be $68.8 million out of a total of $850.8 million, which indicates that while the company is generating some positive cash flow from operations, it still has a significant way to go in terms of achieving consistent and substantial operating cash flow. In conclusion, based on the available data, it appears that the company is capable of generating positive operating cash flow, but it requires further improvement and consistency in its financial performance. The company's debt level has undergone significant changes over the past period. Notably, short-term debt has increased substantially from $131.7 million to $204.5 million. This increase is part of a broader trend in which total liabilities have risen by 32% from $344,855 to $456,884. Furthermore, other current liabilities and accrued rebates to distributors have also seen an uptick. In terms of interest expenses, the company has experienced a substantial surge. Interest expenses have increased by 131% compared to the previous year, reaching $2,955,000. This growth is further underscored by a $3 million increase in interest expenses in 2025. In contrast, interest income has seen a slight decline of 11%, dropping to $4,057,000. Overall, these changes suggest that the company's debt level and interest expenses have undergone significant shifts over the past period. Management is optimistic about the company's outlook and strategy. They expect revenue to increase in the coming years, primarily driven by existing commercial products and recently approved products or indications. The company will continue to make significant investments in research and development, including internal discovery activities, to expand its pipeline through business development activities. The management team has identified opportunities to access capital through debt arrangements on favorable terms, which will provide enhanced flexibility to execute on corporate strategic goals. While the financial results may fluctuate from quarter to quarter and year to year, the company is focused on increasing patient access to existing commercial products and launching additional commercial products to drive growth. In addition, management has acknowledged that the company may require additional funding to support operations in the future, which could be obtained through various means such as equity offerings, debt financing, collaborations, or licensing arrangements. However, this does not seem to be a pressing concern at present, given the company's access to capital and its focus on executing its strategic goals. The company's financial activities have been reviewed. According to the extracted summary, one notable aspect is that the company has not paid any dividends. This decision suggests that the company may be prioritizing reinvestment in its operations or other business ventures over distributing profits to shareholders. Regarding share buybacks, there is no mention of such activity in the provided information. It appears that the company's focus lies elsewhere, and it has chosen not to engage in share repurchases at this time. The company's inventory levels have experienced significant growth over the past year. According to recent data, net inventory has increased by a staggering 87%, with finished goods inventory rising by an even more impressive 91%. Raw materials and work in progress inventories have also seen substantial increases of 74% and 128%, respectively. These numbers raise concerns about potential inventory buildup and supply chain disruption. The company's decision to write down $12.3 million worth of inventory in 2025, mainly due to VYVGART Hytrulo in the fourth quarter, suggests that there may be issues with inventory management. Furthermore, multiple pages within the report highlight concerns about inventory buildup, indicating a need for closer examination and potential adjustments to mitigate these risks. That concludes the financial summary for ZAI LAB Limited. Feel free to comment below, and I will be happy to answer them when possible.